This is Ralph Sass. This is the lecture for Accounting 212, Chapter 9, and this chapter will only be in one part, so we're going to do it all in one here. The whole purpose of Chapters 9 and 10 is to analyze variances. So Chapter 9 is kind of the beginning part of it, and Chapter 10 is taking it in a little more detail. The reason why we analyze variances is, and what a variance is difference, whatever is different from our budget. Okay, we just finished a budget, so now at the end of the quarter or the year, we're going to take a look and compare how we did to how we thought we were going to do, and what we're going to look for is differences. And we're going to analyze those variances to see if they raise any questions. Okay, why are they different? And are there any causes that we can go ahead and take action for so that those variances don't occur in the future? So that's the whole purpose of chapters 9 and 10. Okay. Now the problem is in chapter 8, what we saw when we prepared a budget is that was based upon what we call planned activity, how much we expected to do. But performance is based on actual activity. So in many cases, as the saying goes, we're trying to compare apples to oranges. Okay? Because at the beginning of the year we expected to do X, we really did Y. So the question is how are we going to compare those two? And the way we're going to compare those two is by flexing the budget. So what we're going to do is we are going to take the budget, and we are going to flex it and show what the costs that should have been incurred at the actual level of activity, so we can then compare apples to apples. So we're going to take a look using a lawn service. Larry's got this lawn service. He mows 500 lawns, and they're all very similar. So what happened is this is his planning budget, the budget he did at the beginning of the year, much like we saw in the last chapter. And a couple of quick notes here. Okay, he's got some costs that are fixed. Okay, he's got some costs that are, he's got some costs that are variable. And then he's got some mixed costs. Okay, so you can see that his budget includes, all the items that we talked about back in chapters, 2 or what have you. Now the problem, his actual results came in and he actually mowed 550 lawns. His budget was set at 500, he actually did 550, which meant that his revenue was different, his expenses were different. So now the question is how do we compare those two? And so if we put them right next to one another, notice what we're doing. We are comparing 550 lawns and $40,000 in revenue with 500 lawns and what we expected to be $37,500. Okay. In some cases, he spent more than was expected, and that was an unfavorable variance. In other cases, equipment maintenance, for example, his expenses came in less than expected, so those are favorable. And the real problem here is we're comparing apples to oranges. Okay, it's hard to say that he budgeted for 20 grand in salaries and he actually spent 23.5. That's really unfavorable. It's hard to say that because he mowed more lawns than he thought he was going to mow. So what we need to do is find a way to compare these two. And what we're going to do to compare these two, okay, is create what we call a flexible budget. Now notice a couple of terms here. A favorable variance occurs when the actual revenue is greater than the budgeted revenue, so that appears favorable. An unfavorable variance for costs occurs when actual costs are bigger than budgeted costs. And a favorable variance for costs occur when actual costs are less than budgeted costs. Okay, and now the question that comes up is, since those are unfavorable. Has he done a poor job controlling his costs? And likewise, because they're favorable, has he done a good job? And the problem is we don't know. And the reason we don't know is because we're not comparing apples to apples. We're comparing what we thought he was going to do, the 500 lawns, with the 550. So there are some problems with, okay, and sorry about that, it got hung up a little bit. Let me go back to it quick. The problem with our static planning budget, the problem with what we did in the last chapter, is that when the actual activity is different than the planned activity, okay, it becomes hard to compare them. Okay, so what we're going to want to do is we are going to what we call flex the budget. And quick note, on the exam I typically put a flex the budget type of a problem, okay, where you have to take a static budget and flex it for some level of activity. So what we're going to do for a flexible budget is we're going to take a look at variable costs and fixed costs, and we're going to use the formulas that I pointed out when we started this chapter to go ahead and change the budget and say what would have happened as if we had budgeted for 550 lawns in this case instead of 500. So what we're going to do is create a flexible budget, and on that flexible budget what we're going to say is, let's see if I can, for some reason I'm having issues here, sorry about that. What we're going to do is we're going to flex the budget and say what would have his budget looked like if he had produced 550. Okay, if he had produced 550 mowed 550 lawns instead of 500. So with that, some of his costs are going to stay the same. Some of his costs are going to change because of the different queue, the different amount of lawns. And so now we can go ahead and compare. And what we'll do, okay, what would his lawn, quick question here, what would his costs be if he mowed 600 lawns? Okay, well his wage and salary is $5,000 in essence in fixed costs plus $30 a lawn for 600 lawns. We would have then expected his salary cost for 600 lawns to be 23 grand. I'm going to skip back here 1 second. Okay, so notice here for 550 lawns it was 21.5, and if it was going to be 600 lawns that would have been 23 grand. So the difference between the flexible budget revenues and expenses and the planning budget is what we call, okay, an activity variance. Okay, the difference between the flexible budget and the planning budget is what we call an activity variance, because the differences between the two are because of the different levels of activity. Okay, so let's take a look at activity variances for his particular lawn here. Notice what we have. We have the flexible budget on the left. Okay, we have the planning budget on the right. Okay, so there was the 500. So the planning budget, this is what we did at the start of the year. At the end of the year, this is how we ended up. So we flexed our budgets to do that. Okay, so now we can see, based upon our activity levels, our revenue was favorable. Okay, but notice our expenses here are all unfavorable. Why? Because we spent more. Our flexible budget shows that it should have been bigger than our planning budget, and that's all due to just activities. Okay, so our activity variance here is unfavorable. Now we're going to find out here in a minute, we're going to do a different type of variance. Okay. So notice activity and revenue increased by 10%, but net income increased by more than 10%. The reason why that almost always occurs in business is because of the presence of fixed costs. Now we're going to look at revenue and spending variances. The activity variance is just comparing the budgeted amount, the two budgeted amounts, the flexible budget to the planning budget. But revenue and spending variances are going to be comparing the flexible budget to the actual results. So notice what we have here. In this particular case, what we've done, sorry about that. What we've done in this particular case is we're going to compare the actual results to the flexible budget. Now the actual results were 43 grand in revenue. The flexible budget said we should have done 41,250. So that is a favorable revenue variance. We did more in revenue than we should have for mowing 550 lawns. Now it might have been that the lawns were bigger. It might have been that we did some other work with the lawns, what have you. And then notice that we have some spending variances, and some of these are negative and some of them are positive. And in the next chapter, in chapter 10, we're going to take a look at these in a little greater detail. But a couple of quick notes here. First off, these first two are unfavorable. What that means is to mow 550 lawns, we should have spent $21,500 on salaries. We actually spent $23,500, so we spent $2,000 more than we should have. Why is that the case? Did we have to pay our employees overtime perhaps for these additional lawns? But that's going to be something now that we're going to look at or want to look at. And notice some of them are unfavorable, i.e. we spent more than we should have based upon our flexible budget. But notice some of them are favorable as well. Okay, we should have spent $1,650. We actually spent $1,300. That is a favorable variance of $350. Now usually we think, oh, favorable variance, that's a good thing. Quick word of caution. What we did is we saved money on equipment maintenance. Maybe we didn't have enough time to get the oil changed as appropriate or whatever. If that might be positive, but it also might be a negative in that now the machinery will break down sooner, deteriorate quicker, what have you. So yeah, I saved $350, but it may cost me more to get the equipment overhauled, replaced, repaired later on. So just because it's favorable doesn't necessarily mean it's good. Just because it's unfavorable doesn't necessarily mean that it's bad. Okay, so now we can take a look at some additional things and combine the two reports. Okay, and notice what we have here. If you take a look, what they've really done is combined everything we've taken a look at so far. Here's the planning budget. That one was from the start of the year. Here was the flexible budget. That was the one when we flexed it to 550 lawns instead of 500. And our activity variance is right there. And then what they did is they put the actual results over here. And here they put the revenue and spending variances and put them in a column there. Basically what they've done is taken our activity variances from earlier in the chapter, our revenue and spending variances from more recent in the chapter, and put it all on one report. Okay. So now we can go ahead and see that the difference there was 50 lawns at 30 lawns and versus 50 lawns at 75 lawns. So we can start to take a look at why there were some variances there. Notice we were able to charge our customers a lot more. Might be that it was just a one-time deal or a large lawn or something like that made that difference. Okay, and notice, and we've already talked about that 1750 favorable variance because we actually did more than we would have expected. We actually generated more revenue than we would have expected. Okay. Word of caution here, or a word of, there are performance reports for nonprofit organizations. If you ever look at nonprofit accounting or accounting for government entities, just a quick note, it's a mess. And just because, I mean, even here looking at the university or looking at the foundation, we get money from a lot of different sources, including state funding, tuition fees, grants, what have you, and it can all go in different places. So when you're looking at nonprofit organizations, just be aware that they are a different beast. Okay? Some companies, okay, have just cost centers. And a cost center is a center that has no responsibility for revenue and only responsibility for costs. And so all they're going to have are costs and not have any revenue numbers. Lots of, like a factory, maybe just a cost center and have no salesman attached to it, no revenue attached to that particular location. Keep in mind, one of the benefits or the curses, you can use multiple cost drivers, like we saw back in some of the earlier chapters. The cost drivers here were all one particular, mowing the lawns, what have you. But you could have numerous different cost drivers if you want to make that flexible budget a little more accurate. Okay. Notice, and this just gives you an example, because of the time required for edging and trimming for different lawns, he added an additional cost driver for edging and trimming. And if you think about it, it makes sense. It may take a lot more time to do a small lawn that has a lot of trimming versus a big lawn where you can just ride that mower all along. So notice what he has here. Okay, he's got two drivers, and those two drivers, one is for the number of lawns, okay, and one is for the number of hours, and those number of hours are for trimming, okay, the lawns. And notice he's got, how many lawns he has to trim, and notice he's modified his revenue, because he charges, in this case, $25 an hour to trim, and he's modified his expenses to cover the wages and salaries for 25 hours. He's also covered the gas and the equipment maintenance to take care of the trimmers. So is it possible to have more than one cost driver in one of these flexible budgets? And the answer is yes. Okay. Some common errors, okay, when you're looking at these reports, the big one is assuming that all costs are fixed or that all costs are variable. Notice, if you assumed that all costs are fixed, okay, or all costs are variable, it can lead to issues, okay, comparing your actual to your budget amount. So my point here is just realize costs, most costs in fact are mixed costs, and you can have errors if you're assuming all costs are fixed or if you're assuming all costs are going to be variable. Okay, so all of it, it does depend upon how you want to look at things. Just realize that assuming all costs are fixed or all costs are variable without looking at individual costs will lead to faulty decisions. That concludes the lecture for Chapter 9. As always, if you have any questions, please feel free to let me know.